remember this, which is an important point. I mean, I need you to have in mind this morning before we start. I repeat, I have already shown that, but it's an important point. That's why I like to stress it again. So you see, you have the risk exposure of the project, which is changing over time, which is a key element, I mean, to have in mind to understand really the structuring, the financial structuring of the project, because you have a growing amount of money which is invested in the project in the early phase because you need to complete it, but still the uncertainty is very high. Then you have this early phase with a high level of risk. You start with equity, and then you need to have, because there is a limit to the amount that equity holders are willing to invest in general. They're looking more for debt. So you need to find, you cannot increase the equity because those who are involved in the project, they don't want to share the power. They don't want to share the control. They want to have a full control on the project, but still they need to attract investors who are ready to take risk. Okay, so that's why you need this kind of specific type of financing during the transitory phase, because as you can see, I mean, the high level of risk is not forever. I mean, it kind of disappear after a while, most essentially when once the project is completed, when the infrastructure are in place, well, you can start the operation, and then things should go normally with a good control of risk, and therefore a low risk, and then we have a new type of investors coming in with a no recourse debt. So that's basically the background. So I mentioned yesterday the role of banks. Remember, they are not just providing the money, they're also providing a lot of services. That's why I insist on the fact that it's really project finance is really a field of expertise, a specific kind of expertise in banking. And I insist on that because I think that it might be clear in your mind that there are in this domain a lot of business opportunities for people like you. So keep that in mind. Okay. Well, these are a few information about the leaders as far as project finance is concerned. And you remember we noticed the importance of the Japanese banks and the growing role also of China. Okay. And then coming back to the Seapower here, where it just gives you an idea about the length, the number of months here necessary to prepare the financial schemes. It takes a lot of time to negotiate with all the players. First of all, with major institution, in the case of Seapower, with the European Investment Bank and the ECS, the export credit agencies, which I remind you would provide credit insurance and therefore improve the quality of the debt. It's only once you have prepared the very first document with this basic institution that you can go and discuss with the banks to end up with an agreement. So these discussions have taken place during about 10 months. And at the end of the 10 months, then everything was ready to finance following the first phase. You remember for Seapower, there were 3 phases. One first phase, which was a kind of small part of the project, but which was the opportunity for those investing to show that they had the capability to develop the project further. Okay, so once they have proven this capability based on their expertise, well, they could start serious negotiation for the phase 2 and 3, requiring most of the funds to develop fully the project. So here you have all types of detail concerning this financing scheme. I'm not going to read all that. I have just stressed some points which I feel are important. So, basically, we explained that the financing, the agreement that has taken place, will enable the construction of the second and third phase of the 325 megawatt plant. So it includes, and that's an important point. It includes the refinancing of the already operational 30 megawatt pilot phase. In other words, it's important, and I insist on that usually you have 2 phases in project finance. One, which is the first phase where you have risky investors coming in, okay? And after a while, when most of the risk has disappeared, well, then they can look for another type of debt, okay? Another type of debt to finance the rest of the project, and also to provide a substitute for the first debt that was included. as written here, this amount of financing, 869 million, it includes the refinancing of the already operational 30 megawatt pilot phase. Okay. Well, what is the kind of debt for this second phase? Because most of the risk has been, let's say, resolved. It's a non-recourse financing. I remind you what it means. It means that the lenders cannot really count on the assets of the project company. Essentially, they count on the future cash flow of the project company to repay the debt. Okay, so indeed, that's why this type of debt was not in the first phase, because it was too risky. Okay. Once the first phase has been completed, then the risk is resolved. We know that the project is feasible, and then investors with no recourse debt don't hesitate to jump into the project at that point in time. Well, it was made possible, it's always the same story, by a strong contractual package with contractors. I mean, contractors are companies with an expertise in the field, so it's reassuring. Okay, and because they are experts, they accept to take part of the risk. Okay, that's why you have a good contractual package which is reassuring for the investors. Okay, and well, there is also another point which is important to note. You see, I've indicated this underline this kind of instruments, what we call a cash sweep mechanism. What is a cash sweep mechanism? Well, the idea is that the project will generate cash flows, okay? And the cash flows are there in the first place to cover the debt service. Yes, but what if, for any reason, for instance, for a business interruption or for any difficulty, there is a kind of decrease, significant decrease of the cash flows, okay? And therefore, in this case, the project company could default, might not be able or not have not enough cash flow, to cover the debt service. Well, that's why usually there is a demand from the lenders for the company to accumulate cash in the balance sheet and not distribute all the cash to the equity holder. So there is the need for an accumulation of cash, which is what is called here the cash sweep. Okay, a cash sweep mechanism means an accumulation of cash to have cash available in case, for any reason, the cash flow would decrease for a period of time. So this accumulation of cash, kind of cash reserve, would be used to continue to cover the debt service. Okay. Well, what else? The final, the final clause is a demonstration of trust. I insist on that because I told you that trust was necessary in this type of complex scheme. You can have all type of traditional contracts, legal contracts. It's good to have because these legal contracts are the result of an in-depth risk analysis. Okay, and then based on this in-depth risk analysis, you could have a contractual scheme built with all the necessary stipulation, but you never know what may happen when you have such contract. And I told you that it was important also to make sure that there exists a certain level of trust between all the players. Okay, and it is the case in this project, and this trust is due to the reputation of most of those who are intervening in the project, reputation based on their past expertise, which is well known, and which is indeed again for a kind of reassurance for the different stakeholders involved in the contract. Well, just to conclude on this case, you had in the end 23 contractual parties, okay, including 10 financial institutions, design a contractual framework of more than 20,500 pages. So it's just this number of pages in the contractual framework just give you an idea about the complexity of this type of project. And let me tell you that this project is not the biggest project we've ever seen. We have projects which are much, much bigger than this, with even much more complexity. When we mention 23 contractual parties, let me tell you that this is an underestimation of the number of parties involved, because each of these 23 parties here have subcontracts with other suppliers behind. Okay, so would you look at all those who are involved in the project, it would be much more than this. Okay, well, so it was just here a kind of few comments to give you a good image of the complexity of project finance and of these contractual schemes. Well, so now to understand the financial structuring, the capital structure of the project company, I think it's interesting to refer to a concept of a cash flow cascade. You could say, if you don't understand the word cascade, which is English, but which sounds French also, you could say cash flow waterfall. Okay, so you see the blue line here is a cash flow, okay, and falling from the hill, from the top of the hill, you know, and it's falling down, and you know, at the end you have less and less water left, you know, because you can have some water disappearing at each stage of the cascade here. Okay, so why do we use this image? Because actually it gives an indication about the different position of those who are contributing to the capital structure. You have the senior lenders, they are at the top. So they have a priority, you know, they have a first priority, as we call it, on the cash flow. They serve themselves first, okay? Typically, those who have provided no recourse debt, they have a priority on that, and they will be served first. Once they are served, well, you have some below, there is still water, but less and less, because if you go further down, then you have all what we call the mezzanine financing. Mezzanine financing is a category of instruments. It's made of many different types of instruments, which we are going to look at, but they are positioned in the middle, okay? They don't have a priority on senior lenders who are served first, but they come immediately below. Within mezzanine finance, indeed, you also have a kind of ranking with priorities within this block. And at the very end, finally, you have equity holders, and they have cash if there is enough left once all the others have been served. So it gives you an idea of how the capital structure is built, which is what we have on the next slide. Okay, so let's look at the capital structure of the project. And again, I'll give you a global picture here, but indeed this capital structure will change over time. Okay, so here I just position all the different types of instruments in terms of priority on the cash flows. What do you have? Those who are taking the risk basically are equity holders as usual. Okay, and they have a remuneration if all others have got what they normally should get. Okay, so at the very top, at the very bottom, sorry, you have the equity holders taking basically the most important risk. Well, then after that you have mezzanine, which is composed of different types of instruments. We'll see that, and we call it sometimes quasi-equity. Why? You understand the word quasi? It means it's not equity, but it's very much like equity. Okay, in the sense that it's a guarantee. You know, equity. What is equity? Equity is a safety net for lenders traditionally. Okay, because equity holders take the risk, so lenders have a first priority on the cash flow generated by the company. It's only if cash flows are not high enough that sometimes lenders might not get their money back. In this case, the company would default. Okay, but normally the equity is there as a safety net to make sure that, and if there is enough equity, then the probability of lenders not getting their money back is very low. That's why, you know, you always have kind of equity requirements in the balance sheet just to limit the risk taken by lenders. And you know that the debt rating systems which are in place, for instance, and all the rates provided by Standard & Poor's and Moody's, basically what they would look at to give a rate, they would look at the volatility of cash flow. What is the quality of cash flow? Are the cash flow highly volatile or very stable? Okay, and then based on this, what is the amount of equity necessary in the balance sheet to have a high level of safety for the lenders? If the equity is too small and if the volatility is high, then you have a risky debt, okay, because the safety net is low and the volatility of cash flow is high. And then you would end up with a B, or let's say even C, or just double B, which would be what we call traditionally in finance non-investment grade. Okay, so if you want to be investment grade, that is considered as a kind of safe debt. And I remind you that it starts at triple B. So triple B and over is considered as investment grade, which means safe debt. And then you would pay for this debt an interest rate which is even indeed lower than for risky debt. Okay, but then you would need to have an amount of equity which is high enough to secure the lenders to be rated above triple B. Okay, so the idea is that if you have a safe cash flow and a high level of equity, you have a AAA. If you have a volatile cash flow with a minimum of equity, you are more like B or double B. Okay, well, so this mezzanine is composed of not equity, but what we call quasi-equity, because those who are investing, they take a risk to a certain extent, not as much as the equity holder, but they still take a risk, which will constitute a kind of additional safety net, an additional guarantee for lenders above. Okay, so that's why mezzanine as well as equity are at the bottom of the balance sheet in a block which we called unsecured finance. Unsecured finance, well, I think the word is clear. Equity holders as well as those who participate in the mezzanine financing, well, they are not secured in the sense that they take risk. Those who are above, because they benefit from the guarantee of equity and mezzanine investors, well, they are secured. So what do you find? You still have distinctions at this level. You have a tranche B loans, as we call it usually, or sometimes we say it's a second lien lending. Second lien lending, it means that you don't have a full priority on the debt service, okay, on the cash flows, because you have above what we call the senior debt with a first lien. The first lien means, if you remember the image of the cash flow cascade, means that you have a first priority on the cash flows, and then tranche B would have a second priority. Okay, once the senior debt service is covered, then it comes tranche B. So if the mezzanine financing is important enough and equity also, tranche B is not too risky, but nevertheless a bit riskier than senior debt. Okay, but these two blocks, tranche B and senior debt, are considered to be secured. Usually, tranche B could still be a bit risky. It would be rated commonly around double B. Okay, and whereas senior debt would usually be rated double A or triple B at least. Okay, I don't insist on that, but you could also have, if you want to add to the complexity, even in the senior debt, you could have different tranche also. Some tranche on the top being rated AAA, and sometimes other tranche at the bottom of this senior debt block would be triple B, for instance. But usually senior debt is what we call investment grade debt. Okay, well, I thought it was also interesting to add, even if it's not naturally in a balance sheet or not systematically, you can have leasing. Leasing is can be seen as a kind of financing, and I put it on the top. Why? Because the lessor has a guarantee because he is the owner of the piece of equipment which is financed with leasing. Okay, so there is a kind of immediate guarantee through the ownership of the asset which is financed through leasing. That's why I put it on the top here. So having said that, just to indicate the typical capital structure of a project company, let's come now into the detail of each of these blocks. So let's start with mezzanine. So it is said to be an unsecured kind of financing, or as we say, deeply subordinated. I guess you already have heard of this concept of subordinated debt. When it says subordinated, it means that you don't have a priority. You are subordinated to the fact that others have to be served, other contributors have to be served before you, okay? And there is a third lien on property. It's just to continue the fact that you have first lien, first priority in cash flow. Tranche B is second lien. In other words, second priority in cash flow. When you reach the mezzanine block, well, you have at the third level of priority. Okay. Well, maturity of this debt, it depends on the project. Okay. Usually, mezzanine debt is used during the first phase. Okay. And therefore, the maturity is not always fixed. Okay. But it may correspond to the completion period of the project. Okay. The completion period, which it may be, let's say, 5 years, but you may accept the idea that you may have not only cost overrun, but also delays. Okay, so that you may say that the maturity is normally 5 years, but it may be postponed to 7 or 8 years, or sometime postponed until the completion of the project. Okay, so it totally depends on the project. Well, typically with principal repayment at maturity, okay, you know, since the company used this type of financing during the completion phase. In other words, before operation starts. It means that there is no cash flow generation during this phase. So you cannot expect, I mean, the project company to generate enough cash flows to repay the debt or cover a debt service during this period. That's why in most cases, you know, the principal repayment is at maturity. There is no payment before maturity in most cases. Okay. I should add also that, and we'll see that more precisely with the next slide, that not only the principal repayment is at maturity, but very often also the payment of interest, you know, are paid at the end. Okay, also together with maturity, which is what we call usually we call that a bullet loan, you know, where everything is paid at the end. We'll see the specificity of bullet loan a bit further in the presentation. Well, you often have what we call an equity kicker. Okay, the bond might be what is an equity kicker? It's an equity. It's a kind of option. Okay, giving you the right to become a shareholder if certain conditions prevail. Okay. Typically, for instance, if there is a failure in the project, if there is a kind of interruption in the continuation of the project, well, in this case, the lenders may like to become equity holders to have a say in the, let's say, the solution found for end up the project. Okay, so in this case, if there is a failure in the project, if there is an interruption, then they may exercise their option and say, well, now we want to become shareholders, equity holders, and have the right to say and to defend our position in the decisions which are going to be made following the failure of the project. Okay, to get their money back and to get a kind of priority or to be treated as equity holder in terms of, let's say, control on the evolution of the business. Okay, so that's why typically you may have convertible bonds or bonds with warrant. I guess you have seen that a warrant is a kind of option, by the way. I'm not going into the detail of differences between warrants and options, but it's very much like an option. Okay, so this is what we call an equity kicker. Well, it may include preferred stocks. Okay, preferred shares, if you like. And I will give you some details about these preferred shares. It can be cumulative, convertible. Convertible meaning that, again, there is a kind of equity kicker. You can transform them into normal equity. Participating or redeemable. Participating means that you define a certain, let's say, rule as in terms of dividend payments. You know, if it's participating, it means that if there is a good performance, well, you might receive more and more than what normal shareholders would get, and so on. And they might also be redeemable, that is, they can be reimbursed at a certain date. Okay, so we'll see that with more detail. So you see here you have basically the properties of what you find in the mezzanine block, which includes either subordinated debt, which is a kind of risky debt, or which may include a kind of equity, but it's in terms of preferred shares or preferred stocks, as we say. Now, what about the tranche B loans? Well, they are secured by an agreed portion of cash flow and property. Okay, in other words, there is a kind of priority on the cash flows before the mezzanine and equity instruments are served. Okay, maturity usually not shorter than the senior debt. Okay, because they constitute a safety net for the senior debt. You know, the existence of tranche B loans will improve the quality of the senior debt. Okay, so because they constitute a safety loan for the senior debt, their maturity cannot be shorter than the senior debt. Okay, I think it's easy to understand. Well, and typically with mandatory prepayment from excess cash, if there is excess in cash, then you can have some very often some repayment at that time to reduce, because the excess cash constitutes a kind of guarantee for senior debt, so it can be partly used to pay interest or part of the capital to the tranche B loans. What about senior debt? It's secured by asset or cash flows with the first priority, as I told you. Well, this is a kind of normal debt, usually, except that the guarantee is mostly on cash flows. It can be on assets, but you know, for most projects, the assets cannot be seen as valuable guarantees. If you have a wind farm and if the project failed to produce the cash flows needed, well, it's very difficult to say, okay, I'm going to be the owner of the turbine and sell the turbine. Well, it may be this is not quite feasible. Okay, so you have no real guarantee on infrastructure assets in general. That's why the cash flows constitute the main guarantee, and that's why you have a first priority on these cash flows. Well, often you have covenants. So I will get into the details of covenants. I get you have heard of this concept already. Covenants are kind of guarantees which are demanded by senior debt to make sure that their debt is really safe. Okay, the covenants would be either loan covenants. In other words, the company is committed to limit its increase in debt. You know, the idea is that if you think of a company that would raise additional debt, it would be indeed at the detriment of the senior debtors, because the risk would increase, and they don't want to have this happening, and therefore they impose the constraints on the company, not allowing the company to raise additional debt or to raise additional debt above a certain limit which they would consider as acceptable. Okay, it can be also management covenants, we'll see, which are kind of constraints on what managers can decide for the company. We'll see that more precisely later on. Okay, when it comes to leasing, well, there is a transfer of ownership. Okay, and that's why there is it's a specific. I just mentioned it here because it's used in certain types of projects. The guarantee for the lessor, I told you, comes from this ownership of the asset, which is financed through leasing. Okay, but when you look at the cases where leasing is used, you just realize that it is mainly driven by tax optimization. I guess my colleagues in corporate finance already mentioned that, because you probably have looked at leasing as one of the financing tool for companies, and I guess you already told you that one main reason for this is tax-driven optimization, because you know, if you are not the owner of the equipment, then you can play on the leasing, let's say, annuity, which all the more if the lessor is located in a tax haven. Okay, you can benefit from all type of advantages which couldn't be feasible if you had a normal debt. Well, so this is the, let's say, the few comments I wanted to make on the different type of instrument which exist. Okay, well, nevertheless, a last comment on leasing. We will have to we have to know in the end whether a leasing is a capital or operating lease. Okay, the question is the leasing, when it's used, a pure substitute to a debt? Okay, and if it is considered to be a substitute to the debt, well, it should be treated and reintegrated in the balance sheet, following ASCSB accounting standards. Okay, but if it's a pure rent, you know, if it's considered as a pure operating expense when you pay a leasing, because, for instance, you rent a car or whatever, okay, then in this case, it would be off balance sheet. Okay, so there are rules which are rather strict, which maybe you have seen already. I'll come back to that with the next slide. But there is discussion to have to know whether it's a debt or not, okay, or should be treated as a debt or not. Well, so I told you that particularly for the mezzanine financing, most of the case you had what we call bullet loan. That is a loan with a repayment, all the repayment at the end. Okay. So what are the characteristics of these bullet loans? A loan for which the payment of the entire principal and sometimes the principal and interest is due at maturity. Okay. So let's take a simple example. Let's take a loan of 100,000. Let's take a maturity of 5 years, okay, which would correspond to the number of years necessary to complete a project. Let's take a coupon rate of 6%, okay. Bullet payment, end of year 5, which will include capital plus accrued interest, okay. So, you have a note here to tell you exactly what accrued interest means. Accrued interest refers to the amount of interest that has been incurred, okay, as of a specific date on a loan or as a financial obligation that has not yet become paid out. In other words, you don't pay interest year after year, but each interest is considered as an increase in the debt because this is something you will have to pay at the end at maturity, okay? So that is the way we can show the amount that will be paid at the end. So amount of capital due, you always have 100,000 because you are not repaying the capital before the end. Interest of the year, you have 6%, okay? So if you look at column 1, you have 6,000, so that the total due at the end of year 1, including the interest, which has not been paid, okay? The level of the debt at the end of year 1 will be 106,000, okay? So what about year 2? Year 2, you start again with the capital which remain at 100,000, but now the interest for the year has increased. Why? Because you pay 6%, not on 100,000, but on the amount due at the end of year 1, which includes the interest of the first year, and so on and so on. Okay, so you have the interest element which is growing, not only because you accumulate the interest of each year, but also each year the interests are growing themselves because you pay an interest on also the interest payment which didn't take place the years before. Okay, so in the end, you will have to pay 133,823. Okay, so if you look at it, the final payment at the end is composed of two elements: the principal, which you repay 100,000, and the accrued interest, which in this case corresponds to 33,823. Well, just a comment from an accounting point of view, and don't forget it because that's a point which you have to treat inevitably in your assignment. The interest of the year is not paid, okay? So it is a kind of debt which is accumulated year after year. But there is no payment, but it has to be included as a financial cost in the income statement because this is a cost for the year. Okay, in the income statement, what you find in the expenses is not what you have paid really. It is all expenses that corresponds to the year you are considering. Okay, so if you take the 6,000 for the year 1, you didn't cash out 6,000. Okay, it is accumulated as a debt, but it is a financial cost for year 1. The same for year 2. 6,360 is not cash out, but nevertheless, it should be treated in the income statement as a financial cost for the year, and so on and so on. Okay? Combination, well, that was the most simple kind of bullet loans, but you may have, all type, everything is possible. When you negotiate, I mean, depending on the particularities of the cash flow generated by the project, well, you may like to have this type of arrangement or this type of arrangement. It also depends on what the investors are willing. They have themselves, that, for instance, large investors such as pension funds and so on, they also have some constraints when they manage their liabilities together with their assets. So they may also demand some characteristics for the loans that would fit well to their own financial management strategy. Okay, so everything is possible. So here we're looking at a ballot loan, which will be a bit more complex than the basic case which we have seen before. So we have, in this case, for instance, a combination of an amortizing loan with a ballot loan, and that is possible and frequent. The loan amount would still be 100,000, but still a maturity of 5 years. Interest rate, let's keep it at 6%. The grace period, which is a very frequent element, would be 2 years with no capital repayments and no interest. Okay, so you have a grace period that might cover the very first phase of the completion. Okay, maybe after 2 years, if the first phase is completed, then you start generating cash flow and you may like to start repaying the loan. So there is no capital repayment during these 2 first years. After that, from years 3 to 5, you have a partial amortization of 20,000 per year. Okay, which means that from year 3 to 5, 3, 4, 5, okay, you will pay altogether 60,000, which is 60% of the total amount. So in the end, what will you have to pay? Interest which are not paid, which have been accrued, okay, and also the remaining principal, which would be 40%, in other words, 40,000. So interest 6% of due capital payment of accrued interest at maturity. So the ballot payment end of year would be 40,000 plus accrued interest. Okay, so if we just look at what it means, this is what you have here. So you see the amount of capital due end of year 1, 100,000, end of year 3, end of year 2, 100,000, year 3, 80,000 only because 20,000 of the principal has been repaid, and so on. Decrease of 60,000 for year 4, and finally 40,000 for year 5. The amortization is 20,000 for year 3, 4, 5. Okay. So what are the interests of the year? 6,000 for year 1, 6,360 for year 2 because you have to pay interest on the first interest which you didn't pay. Okay. After that, 6,742, same idea, but you see after that the interest would decrease. Why? Because the part of the loan has been amortized, then the total due at the end of year 3 is lower. Okay, it's decreased because of this partial principal repayment, and so on. So the payments would be 20,000 for year 3, 20,000 for year 4, and for year 5, 40,000, which is the remaining. Okay. Plus the last tranche of 20,000, plus the accrued interest. Okay. So the payment would be all that. Okay. So final payment for the year 5, what do you have? You have the last amortization, you have the accrued interest, and you have the principal repayment. Well, so you could imagine any type of formula. As I said, I repeat, it depends on both the necessity of the project and also the demand coming from investors who have their own financial strategy with their asset liability management issue. Well, so difficult to read. I gave that more for your information, but we can look at few things together so that I can make comment on some specific point. I gave that to you as a kind of list of instruments to make sure that you have a clear definition for each. Introduction, mezzanine finance. So it is composed of unsecured debt usually, or preference shares, as I told you, and they offer a high return. Why a high return? Because there is a high risk. In other words, this is sometimes we say junk bond, but junk bonds is not quite nice, So we say high risk debt. Okay, And high risk debt means a debt usually below BBB, okay, and high yield, that's expression which is used. So it's part of the high yield segment of the debt market, okay. And high yield means a spread which corresponds to BB or lower. And the spread indeed depends on the price of risk on the market, which today is not that high, actually. Why? Because there are many investors who are looking for this type of debt because they desperately look for returns. And since the safe assets provide a very low return, actually, many investors are looking for these high risk instruments. But then, since many investors are willing to get this high risk instrument, then the remuneration, the spread they get for the high risk instruments is going down and further down. So it starts going up again a bit, but it's still very low from if you adopt an historical perspective. Well, it's indicated here that this debt generally offers rate of 2 to 5 percentage points more than on senior debt. Well, it depends on the conditions of the market, and that was written, at a period which does not totally correspond to what we experience today. And as mentioned here, mezzanine finance tends to be used when we have reached the limits of what banks can provide. Okay, banks are ready to provide loans in certain conditions, but banks are have to be careful with their level of risk because there is a strong regulation. Most of you have heard of Basel II, so they are concerned with the quality of their balance sheet, okay, and they don't like to take risk. So if we reach the limits of what banks can normally provide, reasonably provide, considering the necessity to maintain a certain quality of their balance sheet, then that's where they go on the market to find investors that would accept to take risk in the project. So you also have preference shares. Preference shares, the interesting thing is that it's a kind of equity, okay, but usually there are no voting rights. So it means that the normal equity holders, they keep a full control on that. Except indeed that, as I said, you often have an equity kicker, which allow those who own this type of shares, these preferred shares, well, to become pure equity holders in case of difficulties in the project. Becoming pure equity holders, well, they can have a say in the decisions which are going to be made. Okay. Well, after that, concerning the remuneration of the preferred shares, you have many types of solutions. They can have a fixed dividend, or they can have sometimes they can benefit from extra profits where they would have an increase. They would participate in extra profits. Sometimes they don't. I'll let you read this. You have all the details, but keep in mind that everything is possible. In the end, you can have, let's say, something that is just designed to fit exactly what investors need, and as I said, and what the project also needs. Okay. What else? Another kind of description of different preference shares. It can be cumulative. You just read what it means here. If dividends are missed in any year, well, the right to eventually receive a dividend is carried forward. So we call that cumulative. That is, even if for any type of reason the company was not in a position to pay dividends, then they will have an accumulation. It's like accrued interest. It's accrued dividends in this case. Participating, as well as a fixed payment, the dividend may be increased if the company has high profits. That's what I said. And redeemable, they have a finite life. That is, they're issued with a certain maturity, and then the shareholders, the holders of this type of preference shares, would get their money back later on. Okay, they can be convertible, as I said, convertible just to become shares, particularly if there is something happening. Okay, or it can be convertible. It can be seen as a kind of option offered to the shareholders. They come as first of all with a kind of guarantee of dividends. And if they feel that it's a good deal, well, they might sometime be offered the possibility to have the option to convert their share into an ordinary share. Okay. So you have the golden shares. You have heard of that also. These are shares with extraordinary special powers. So golden shares are used usually to avoid the takeover of a company. Okay, so it is not always welcome by financial markets because it's a way to block the possibility of an acquisition. Okay, but it may be used if the equity holders want to make sure that they will keep control of the project. Well, so let's look at the future now, because I gave you a description of the the most common practice as far as project finance is concerned in terms of the detail of different instruments which are used. Well, what are the prospects? Well, today I don't need to insist on the fact that there is a sort of economic uncertainty which prevails and lots of geopolitical tensions. You have complexity and heterogeneity of project finance instruments, which are obstacles to the project funding. You know, there are some difficulties to fund project today. Why? Well, there are two aspects. There are difficulties on one side because the banks in particular, following the crisis in 2008, they have to face a much stricter regulation. And that's why they are very much concerned with the quality of their balance sheet. Okay, so that constitutes a limit. On the other hand, you have a lot of investors who are desperately looking for return in a period of very low, sometimes negative interest rates. So that's more a positive point. But, you know, and that's why there are all types of new solutions which are looked for to try to find more and more money from investors outside banks. Okay, so there are new solutions which emerge. First of all, a few comments. There is a high level of debt ratio in the world and a growing uncertainty which make more difficult the funding of infrastructure, particularly for the most risky project. Okay, that's a point. The reliance on bank lending is a problem for banks because they have a refinancing risk. Okay, you know, as I said, the banks may accept to enter a project, and all the more if they know that the money they invest there, they can get their money back through refinancing scheme. Okay, and that's why there is a need to develop market instruments to facilitate the refinancing of banks. Okay, so infrastructure assets are now becoming a new asset class through standardization. That's the main trend which we observe. To facilitate this refinancing of bank, what you need is a market on which, a secondary market on which they can sell back the instruments which you had issued in the first place. Okay? So there is a kind of standardization which helps for this because, you know, standardization contributes to increase the liquidity of the market. Okay? Because if it is standard, it means that you have enough asset of a particular kind that can be traded on the market. If each type of instrument which is used is specific, it means there is, you know, you cannot have a market for just one single instrument that would be unique. Okay, but if you have a standardization process, then it means that you may have a lot of instruments and enough capacity, I mean, to build a market on which you have a certain degree of liquidity, which will be useful for banks to refinance their instruments. Okay? The result is a simplification of refinancing or securitization. Okay? Which is what banks need indeed to develop their activity, to continue to develop their activity in project finance. If you want to know more on this, well, I just mentioned two papers, particularly one from the Asian infrastructure finance, which explain rather well all these issues. Okay, you also have a paper in Infrastructure Asia, standardizing of project finance loan documentation, well, which is exactly part of the trend which I'm explaining here, creating standards, simplification, and so on that would create more liquidity on the market, helping banks to refinance their loans. Well, there is another trend which is very important for you to be aware of. Okay, it is green bonds, and it's really is important in infrastructure project because most infrastructure have an environmental impact. Okay, it might be a positive environmental impact, which is typically the case for the wind farm, for renewables. Okay, it might be also a negative impact. Okay, if it's infrastructure that would contribute to, for instance, a toll road, might be useful in terms of economic development, but some people would argue that it destroyed part of biodiversity, that it takes land at the detriment of agricultural activities, and so on and so on. Okay, so some other project would have a strong impact on water resources and so on. So, you know, infrastructure development is very much related to environmental protection. Okay, so one way or another, this dimension needs to be taken into account. Okay, so what are green bonds? They are developing very fast. I will show you some figures. Okay, the various types of bonds or loan have their green equivalent. In other words, what makes the difference between a normal bond and a green bond is not the nature of the bond and the characteristics. It is just the proceeds of these bonds which characterize green bonds. Green bonds are bonds which are issued to raise funds that would, when invested, contribute to improve the environment. Okay, proceeds from these bonds are earmarked for green projects that are backed by issuers' entire balance sheet. Okay, and you can, if you want to know more about this, you can read the document which I indicate here in the bottom of the slide, which is a climate bond initiative. You have a report from this, which is a European initiative, and you go to the web link and you have all type of explanation about this. So the characteristics of green bonds, it's not a really technical. It's not the way the bond is structured. No, it refers to what do we do with the money we get from the issue of green bonds. So here, I just want you to realize the impressive progression which we observe on this market. You know, these are most recent numbers. These are numbers for end of 2020. Okay, we've reached 1 trillion. Okay, 1,000 billions. So it has become now a market which is not a minor market. Okay, and you have here what is called a green project mapping. Okay, which is proposed by the International Capital Market Association. You know, and green bonds can be characterized depending on their environmental objectives. Okay, so you have, if you take, for instance, the type of project, renewable energy, that would be the case for a wind farm, for instance. Well, the objective, that is the way the project would improve the environment so that the project would qualify for the issue of green bonds, okay, is climate change mitigation, typically, natural resource conservation, okay, and pollution prevention and control. Okay, you know, but you have the primary objective, which is the dark green with 3 dots, okay, and then secondary with 2 dots, and tertiary minor impact with the green, the single dot. Okay, energy efficiency, that is any type of if within a project you can show that the technology you are using and developing would contribute to improve energy efficiency in comparison with the most traditional technology, then you will also have the possibility to benefit from the green bond initiative. Okay, and again here in this case, for instance, the main objective would be climate change mitigation also. Okay, and pollution prevention and control as a minor objective. Pollution prevention and control in itself can be a characteristic of a project. Okay, It can be, for instance, to develop a water treatment plant. Okay, and this, in this case, you know, the main objective with 3 dark dots would be pollution and prevention control, and so on and so on. So you have a grid here, which give you an idea about what do you need to do to have the possibility to participate in the Green Bond Initiative. Okay, to, let's say, qualify for green bonds. No need to say that many companies now, each time they need money, they try to see whether they could tick with one of the cases here so that they would qualify. Okay, so now there is a question, it's whether it's quite always reliable, this type of classification, because companies can always try to argue to show that they would one way or another contribute to the improvement of the environment. Okay, so we could discuss also about the relevancy of all these these classifications. Well, green bonds. Why should we issue green bonds? Because after all, it's exactly the same as normal debt. Okay. Well, the good reason to do so is that it costs you less in terms of cost of funds. Okay. The standard bonds with a bonus, green bonds are sometimes defined as standard bonds with a bonus on green, with a bonus green feature. That is, a bonus green feature means a lower interest rate. Okay. And what is the kind of size of this bonus? Well, here you have a graph which considers some we see the German case, you know, so it cannot be necessarily generalized for all green bonds, and it is at a point in time. But what it shows clearly is, you know, what you measure on the vertical axis is the level, the gap with the spread with a standard bond. For instance, you start from the bottom. Well, you were around minus 0.02. Okay, it means that in terms of percentage point, the cost of a green bonds was 0.02% lower than a standard bond. Well, if you look at the situation now, okay, the change between September 2020, you see, and today, because the last figure is for the very recent date, you know, it was in April 2021. Okay, you see that we have moved up to minus 0.05%. It means that 0.05% less than a standard bond. When you look at it, it might be a small, you might see that as a kind of, it corresponds to 5 basis points. Okay, you might consider that it is rather small, but you know, if you borrow hundreds of millions, well, it makes a bit of a difference in the end. Okay, so green bonds dominate sustainable debt market. You see, green bonds is the blue curve. You see how it increased from 2012 to end of 2020. You see a dramatic increase in the volume of green bonds and the green bond issue. That's the issuance by in billions, the issuance by instruments. You know, you also have social bonds, sustainability linked bonds. There are other type of bonds, but the green bonds are really dominating. Well, there is a sustained demand for these bonds, while funding needs progress at a lower rate. Well, the idea is that what we observe on the market is that the investment in infrastructure is not growing as fast as it should. There are huge needs in infrastructure, but today the progression of investment in this field is not growing that fast because of the kind of uncertainty. COVID-19 has probably also been, let's say, a reason for the kind of slowdown on infrastructure development. So we experience a period where there is a huge interest in green bonds, people willing to invest in this. Remember what I said about the so-called ESG fund, which stands for environmental, social, and governance or impact investments. You know, these funds which are really trying to find good projects which will have a positive impact, either social or environmental. So there is a strong demand or a supply of funds for this type of project. On the other hand, this type of project is not growing so much, so the need for funds is not growing so much. So the consequence is, if you have too much money going in an area where there is not much need of funds, well, it explains to a certain extent the fact that the cost of this fund is decreasing. Okay, and that is indeed a recipe for a bubble. So there is a kind of discussion right now to see that. I have just seen that in the last issue of The Economist, you have a paper on that, looking at the risk of a bubble around green bonds. But even if we have a bubble now, for sure, in the long term, you can consider that green bonds will remain dominant instruments today, considering the huge need in infrastructure and the very important issues which have to be dealt with as far as the environment is concerned. Okay, so now you have a kind of view of the main type of instruments which can be used. Okay, mezzanine financing, preferred shares, traditional equity, senior debt, and so on. Now, let's come back to the issue of the cost of funds. How can we measure the cost of funds? So far, the cost of funds, we have essentially treated it through the level of the interest rate. Okay, but now I want to insist on the fact that you cannot just consider the interest rate to have an idea about the cost of funds. Particularly when it comes to project finance, because you have understood that it was rather sophisticated. Okay, you can, if you define, for instance, a subordinated debt, it may be a contract of more than 100 pages with lawyers writing very precise, very complex documents and so on to stipulate exactly the conditions of subordination. Okay, so all that is expensive. So it's not only the interest, okay, cost which has to be taken into consideration. For each of these instruments, you have specific type of cost, explicit or implicit. And that's why the determination of the cost of funds is really a difficult task, but you need to know all the different components for each instrument. So let's start with equity. The cost of equity, I'm not going to insist on that. You know that it's a required rate of return for equity holders. Okay, they take a risk, they had a risk premium, and I'm not coming back on this issue, which is well treated in corporate finance. Okay, now when you move to hybrid and debt instruments, hybrid means intermediate. It's another word for quasi equity. It's hybrid because it's a mixture of debt and equity. Typically what you find in mezzanine financing. You have arrangement fees. The arrangement fees are not small. It's it's why banks are so interested in project finance. That it's if they contribute, if they are arrangers, well, they will get the arrangement fees. Okay, and these fees can be quite substantial. Okay, they might be look like a minor element because it might be 0.01%, okay, of the amount of the loan. But when you look at the amount spent for infrastructures, 0.01% can be a very good and substantial arrangement fee. Cash interest, which is what you pay as interest, okay, which is the traditional way to look at the cost of funds. But you also have what we call payment in kinds, PIK, which corresponds to accrued interest. As I said, if you look at the cost of funds for a particular year, the question is not whether you pay or not the interest. The question is, what are the interests which you are going to charge to this particular year? So accrued interest have to be taken into consideration in this case, even if they are not paid out. Embedded options. If you have an equity kicker, for instance, you have a subordinated debt with an equity kicker to participate in the discussion if there are certain conditions that prevail. Okay? Well, options are not free. There is a basic rule in finance anyway that there is nothing free. Okay? So if you have an embedded option, there is a question, well, it's free. Probably my colleague in corporate finance told you that. If you have, for instance, a bond, convertible bond, you know what a convertible bond is? It is a bond, in other words, a debt instrument, but attached to this bond, you have an option, which is the right to convert this bond into an equity. usually these bonds are priced in terms of interest at a lower rate. For instance, if the normal traditional bond, if what we call a vanilla bond, the most simple type of traditional bond which can be issued, if you have a vanilla bond which is issued at a rate of, let's say, 5%, maybe a convertible bond will be issued at a rate of 3%. Some people, would consider that, it's good to have a convertible bond because they are cheaper, okay? So companies would just realize that with convertible bond, the interest payment they have to do is 3% rather than 5%. And the cost of funds seems to be cheaper. Well, actually, it's not. Why is it 3% rather than 5%? Because the holder of the bond is offered the option, okay, to become an equity holder, and therefore later on to have a kind of power in the company if the option is exercised. Okay, so this option, the price of it does not appear clearly, okay, but there is a cost, an implicit cost, which is the price of the option which is given together with the bond. It's the same for all the instruments for which there is this type of possibility. Each time you have an option attached to the instruments which is used, you should take this into consideration to try to kind of assess the cost, the implicit cost. It's not always easy because, you know a basic model to price an option, which is Black-Scholes. You probably have seen Black-Scholes with a model with my colleagues, okay? But applying Black-Scholes to an equity kicker is not quite easy, okay? Therefore, the idea is not necessarily to measure precisely the value of the options, but to take into consideration that they exist, and that whatever you measure, the cost might be a bit higher than what appears objectively in the accounts. Implicit cost of covenants, it's the same. Covenants provide the possibility to lenders to put some constraints on what managers can do. Okay, the managers, for instance, may not have the right to increase the level of debt of the company, okay, or to go further than a certain debt equity ratio. Okay, this is a constraint which limits the possibility. There is an opportunity cost linked to that covenant. Okay, so each time you have a covenant, you have a kind of opportunity cost, and this opportunity cost is also difficult to price, but you cannot ignore it. Okay, you cannot ignore that there is an opportunity cost. So normally you should try to make an effort, but at least you have to be, even if you can't have a precise measure of it, at least you should not forget that you have this opportunity cost. So what are the typical covenants? Because we mentioned that. Loan covenants, so limits for new loans, or reference to selected debt ratios. You understand why these covenants exist, because if you are a secure if you have a secured debt, if you are a senior lender, you want to remain with your guarantee, and you don't want the company to increase the risk by taking additional loans above a limit which you consider would deteriorate the quality of your debt. Okay, management covenants. For instance, if you develop a project, okay, you raise funds using as an argument to attract investors, you use as an argument the quality of your business plan, okay, and the quality of your project. And you show that you need money to do this and this and this and develop the project in this way to reach this objective. As part of the management covenants, what you have most of the time is that they need to have a verification that you comply with the investment policy you have announced. You are doing what you said you would do, okay? And in case you wouldn't do that, the lenders might have the right to take their money back and to ask for getting their money back. Covenants on the dividend policy, cash sweep, we discussed this concept, which is very common. Even if you have a senior debt, if there is any problem with the project, for instance, you may have a business interruption. Okay, that's a typical case. The business interruption means that during a period of time, the operations are interrupted, and then there is no cash flow coming in, and you may not be able to cover the debt service of the period. So that's why it is considered as a safe policy to accumulate a bit of cash in the balance sheet, to have cash available as a kind of reserve that would allow, I mean, the company to take out of this reserve and cover the debt service, even if the cash flow is not high enough for the period. Okay. Board representation. Lenders may decide, particularly in project finance, when sometimes they represent up to 30% of the total funds. Well, it is fair enough to consider that they can be represented at the board. There are two objectives. One is transparency, to make sure that they are well informed of everything that is going on in the company, and also to have a certain influence in the decisions. Okay. Adherence to the business plan. This I mentioned that also, and remedies in case of distress. That is, they may like to impose some remedies in case of distress, which is indeed a particular case where you understand that senior lenders want to make sure that they will be well treated in case of distress. So these are the typical covenants you have, and it should be considered when looking at the cost of funds, because behind each covenant you have an opportunity cost. Another point I want to treat now is the case of leasing. I told you that there is a question concerning leasing, because there is always a question to know whether it would be a capital lease or an operating lease. A capital lease is when you consider that the leasing is just a substitute for a debt. You know, rather than borrowing money, you take a leasing. Okay. Other lease could be seen as the acquisition of an outside service. Okay. For instance, it is clear that if you need a certain type of small equipment which need to be renewed every 3 years and be maintained in good condition, you may have a lease contract for that, and it would be, in this case, an operating lease for a current equipment which you don't need to own yourself. Okay, so you would buy the service of an outsider, which usually would supply the equipment and at the same time maintain it and so on. Okay, so in this case, it would be an operating lease. Well, actually, there are rules. What is important in particular is to see when it should be treated as a debt, because in this case, it means that it should appear in the balance sheet. Okay, so what are the rules? I just remind you the rules. These are the stipulations of the Financial Accounting Standard Board, the FASB. Okay, if the lease life exceeds 75% of the life of the asset, in other words, if you have an asset that is expected to last 20 years, and if you have a leasing for 15 years of it, well, it would consider that it's a substitute for a debt of 15 years. Okay. If there is a transfer of ownership of the lease to the lessee at the end of the lease term, well, if you lease an equipment, you lease an asset, but at the end you become the owner of it, well, we will consider that it was a kind of substitute for a debt also. If there is an option to purchase the asset at a bargain price, that is at a price which is very low, it is as if condition 2 was fulfilled. Okay. I don't insist too much on this because it is not specific to project finance. I'm pretty sure that you have seen that in corporate finance already. And the fourth condition is if the present value of the lease payments, you look at all the lease payments, you know, and if you realize that the discounted value of all that exceeds 90% of the fair market value of the asset, it means that it's really a substitute to a loan. Okay, and if one of these 4 conditions are fulfilled, then the capital lease should be reintroduced in your financial analysis as a kind of traditional debt. Well, growing importance of impact financing. There are some additional elements which maybe I should have developed with the green bonds, but which I want to add. Okay, just to that we still have to do with this impact investing issue, because here you have some new financing tools. There are guarantees, first of all, which are given. Guarantees are used to enhance credit. You know, if you can prove that your investments has a positive impact, either social or environmental, okay, then you can have a kind of guarantee which comes from investors who are willing to have an investment with impact. And it is often attached to a grant, okay, or some guarantees that would reduce some type of risk or potential losses, okay, so that the quality of your debt would be increased. It's a typical type of credit enhancement. And that relates directly to, these are new type of guarantees which are developing and which are designed to attract what we call impact investors. It's a complement to, you have funny words such as catalytic first loss capital. Catalytic first loss capital, called CFLC, refers to an investor or grant maker agreeing to bear the first losses for an impact investment in order to catalyze participation by other investors. Here, these are investors who are coming in the first phase of a project if the project is a bit risky. Why does it exist and it is appearing now? Because as far as the environment is concerned, you have all type of new technologies which are being used now, okay? So these new technologies are not yet fully proven, okay? So since they are not yet fully proven, they are risky and you will not attract easily investors. That's why some investors are saying, well, now we want to contribute to the progress in the field. So we want to give a chance to this technology. We are going to take the first risk, okay? They are going to catalyze. Catalyze means they are going to facilitate the development of this type of technology. They are kind of facilitators by taking the first risk and the first losses so that it will reassure the later coming investors. SIB, the United Nations Development Program, defines social impact bonds. You know, it's a kind of, these are bonds also which are very similar to green bonds, but here it's promoted by the United Nations Development. It concerns mostly developing countries. Okay, they would provide some kind of advantages for those who invest in bonds of that kind, which are supposed, again, it's not the nature, the technical nature of the bond which is concerned. It is the use of the proceeds. It's like the green bonds, but if the proceeds are used to have a positive social impact. Okay. So now some reference in the field, actually to orient the investors. Now, I just want you to know about the existence of these indexes. I have already mentioned them, but the two major leading indexes, we use the word CSR, which stands for corporate sustainability, and R, sorry, I'm a corporate social responsibility index. That's it. Well, it's the same as impact investing. It's the same as ESG. The problem is there is a bit of a confusion now because we use all type of wordings. So CSR would be very similar to ESG or to, let's say, impact investing. Okay. Well, and there are indexes which are kind of selecting companies which are recognized for their contributions, either on a social point of view or on the environmental dimension and so on. And the leading indexes are the FTSE4Good in London and the Dow Jones Sustainability World Index in New York. Okay. So, and if you want to know more about it, again, you have some references here. So you see what you need to keep in mind is the rapid development right now of new type of instruments which are there to meet a kind of investors' demand, willing to invest, as we say, with impact. It may include an impact on the environment, that would be typically the case of green bonds, or it can be a social impact, okay, which would be typically investment that would contribute to enhance the health the safety on the workplace, for instance, for the employees, or that would have a positive impact in terms of skills acquired by the population that would contribute to the development, and so on and so on. Okay. Well, and the only thing we can say is that there is today a kind of risk, which is a risk of a bubble, because there are many people willing to invest with impact, more and more investors. It becomes more and more popular, and indeed, there is, to a certain extent, a shortage of supply of this type of instruments that would correspond to the need of impact investors, which create a kind of bubble today. Okay. Well, so now the next step is to look at what we call debt cover ratio. Okay, so we have seen all the type of debt, all the type of instruments we can be used, with a tendency to have these green and social bonds and the like. Okay, now what is the level of debt which is acceptable in a balance sheet? We said, for instance, I told you that in most cases, well, we move up to 30% of equity, but still with 70% of debt, which is a huge amount. Why 70? Why not 60? Why not 50? Why not 80? So now what we are going to look at is the ratio which are used by banks to see whether a level of debt is acceptable or not. Okay, but I'm just looking at my watch. It is 10:30 for me, so I don't know exactly what time it is for you. It might be 3:30 if I'm right. So I think it's the right time for a break. Okay, I don't know what you. I'm pretty sure you would agree with me. Okay, so let's. Sorry. So let's have a break. As usual, 15 minutes. So see you in 15 minutes.
You are currently the only person in this conference.
Are you back? Yes, you're ready? Good. So you can see my screen again? I hope so. Because it seems it was interrupted. Can you see my screen? Yes? Okay, good. So let's come back to the final part of. So here we were. So the question is, how much debt can we have in the project company balance sheet? There are two ratios which banks are considering, the ADCR, which stands for annual debt cover ratio. Then you have the LLCR, the loan life cover ratio. So these are very simple concept, which I'm going to describe with a simple example. So here you have a table with a few things. The first line is the CFDS, which stands for cash flow available for debt service. You know, it's equivalent to the free cash flow. You remember? We just indicate when we use the expression cash flow available for debt service, we just indicate that this cash flow is, first of all, available for the debt service. Okay? It's only what remains that goes to equity holder. Why do we use this? Because you have understood that for most instruments, you have a kind of priority. Okay? That's why we look at this concept of cash flow available for debt service. And let's assume it's expected to grow starting from 400 to 455 and then stabilize at 550 year after year for a period here of 6 years. Okay? What is the outstanding debt? Let's assume we start with 1,000. Okay? Let's assume we have a debt repayment of 200. That's a principal repayment. Okay? So that's why the outstanding debt is declining from 1,800 and so on down to zero at the end of the period. The interest payment indeed would depend on the interest rate and the level of debt. So if you have 60, it means that you have a 6% rate which apply to 1,000 in the first year. Then you have 48. Why? Because you have 6% again, but which apply to 800 only, and so on and so on. Okay? So the debt service is the addition of debt repayment plus the interest payment, which is 260 in the first year, and then 248, 236, and so on. Okay? So what is the ADCR? The question is to see whether the cash flow available for debt service is high enough to cover the debt service. So the ADCR is just a ratio that expresses how many times the CFDS cover the debt service. If you have in the first year, it's a ratio, the CFADS over the debt service, you find 154 in the first column, in year one, which means that to start with, the CFDS represents about 50% more, exactly 54% more than what is needed to cover the debt service. So in other words, you have a kind of margin of 50% in addition to what is needed to cover the debt service. And you see that this rate is increasing. Why? The rate is increasing because the ratio is increasing because the cash flow available for that service is growing with the activity. We start from 400, we move up to 500, okay? And since you have debt repayment, actually, year after year, you have a decrease in the debt service due to lower interest to be paid, okay? So it is increasing regularly. So now, this one is easy to understand. So how do we choose? Can we say that 150 is enough, 180 is enough, or whatever? Well, indeed, it totally depends. It totally depends on the. Excuse me for a minute. I just want to skip one thing. I'll come to this later on. Well, it essentially depends on the level of safety you want to have. if you are really demanding in terms of safety, you will prefer a ratio, let's say above 2, saying that the cash flow available for that service should be at least twice the amount needed to cover the debt service. That would correspond to a guarantee rather higher than the 150 ratio. Okay? So this is a calculation which is made year after year. And I will come back on later on what should be a reasonable ratio. Now, the other ratio which is used is the loan life cover ratio. As it is indicated in the name of this ratio, loan life. In other words, you are not have a calculation year after year, but you will take into account all the remaining period. Okay. For instance, what is 197? You take actually, if you take to start from column 1, what you will be looking at is all the future cash flows. Okay. And you can see that all the future cash flows constitute a guarantee for the repayment of the debt. Okay. So the idea is to compare the present value of all future cash flows, which you compare to the outstanding amount of the debt. So the LLCR is defined as the present value of future cash flow at the cost of debt, because the cost of debt includes normally a risk component. So it's the appropriate discount rate for valuing the future cash flows, okay, until the end of the loan period over the outstanding debt. In other words, to make it simple, you just look at the value, the present value of all future cash flows, which you compare at the outstanding debt. In other words, when you have 197, let's say 2, it means that the present value of the future cash flows starting year 1, okay, is about twice the outstanding debt, which is 1,000. Okay. So now, excuse me, I come back to this slide. I had a small problem with my computer. Okay, so 197, why is it 211 here? Because we're looking at all the future cash flows starting from year 2 now. Okay, so the present value, which is calculated in the ratio here, is the present value of all the cash flows to come. You just forget now about the first one because we are looking at year 2. So the cash flows first one has gone. Okay, so you look at the present value of year 2, 3, 4, 5, 6, which you compare to the outstanding debt year 2, which is only 800, and which explains why the ratio is a bit higher, just because the debt is lower and still you have growing cash flows here. Okay. Well, so now the question is, as I said, what is a good limit? It's always the same story. So the expected free cash flows of the project. Expected free cash flows of the project, we have it in the table. Stable after year after year at 1,000. Let's take an example. It would be it doesn't refer to the table before. So we assume a case where the cash flow will be regular 1,000 year after year, with a volatility measured by the standard deviation of 200. Again, for the sake of simplicity, let's assume a normal distribution. Okay. What would be the bank lending limit? What kind of rule the bank will use to define the limit? Here we can say, for instance, that the bank would say that the probability of default should not exceed 1%. So the probability of default should not exceed 1%. How to express that in probability terms? It means that the probability of a free cash flow lower than the debt service should not exceed 1%. Okay. Then we are going to use that rule to find what is the appropriate cash flow. So what is the critical limit? If you say it should be, the probability should be lower than 1%, then you will take, if you assume a normal distribution, you would look at the maximum annuity payment that is acceptable by taking the expected free cash flow, which is 1,000, minus 233. Why? Because you remember 233 is the coefficient that applies to a probability of 1% as a limit. Okay, so minus 233 lambda, sigma, sorry, the standard deviation, okay, which is 200. So if you do this calculation, you find 534. In other words, it's an exercise which is very similar to what we have done already when we were looking at risk measures. Okay, you look at the expected free cash flow, 1,000. You look at the left side, okay, and you find 534, which means that the probability of a cash flow lower than 534 is 1%. Okay, so the annuity payment should not exceed 534. Okay, because would it exceed 534, then the probability of a loss higher than, of a cash flow lower than the debt service would be higher than 1%. Okay, so the annuity payment should not exceed 534. In other words, if you compare this amount to the expected cash flow, it means that the ADCR should at least be 187, which would be a limit that the banks would apply to comply with this rule of avoiding a default or a probability of default which should not exceed 1%. Okay, and we could have the same type of analysis for the loan life cover ratio. Okay, but this is a simplified version indeed, but it is roughly the approach that banks would use to determine what is the maximum that is acceptable in terms of debt service. Okay, so you see the maximum is not determined with reference to an amount of loan, because after that it will depend on the cost of debt and so on. Okay, but the focus is on the debt service itself. What is the capacity of the bank, of the project to cover the debt service? And then once you have the debt service, you can go up and see what is the maximum loan that is acceptable considering the cost of debt, and considering also the principal repayment pattern. Well, so I have finished with the course in itself. Now there are just few things I would like to do. One thing is I would like to make a few comments on, let's say, few comments on the readings that I gave you, which constitute a complement to my course and which I strongly recommend for you to read, and that would be helpful anyway for your assignments. So the readings are there normally, you have them online. So what do you have for the reading? First of all, some readings which have to do with the project finance activity in Asia. So you have this reading, which is Asian infrastructure, which is was published in 2019. Okay, Asian infrastructure finance 2019, which is indeed interesting for you because it gives you an Asian flavor. Okay, and it's jointly published by the Asian Infrastructure Investment Bank, AIIB, and the Economist Intelligence Unit. Okay, so this document is very instructive. Okay, you have a lot of data about what's going on in Asia as far as project finance is concerned. Okay, so I really recommend you to read that quietly. You should understand it based on following the explanation that I gave you. Okay, and it will give you a good idea about what's going on, and it might be interesting for you if you want to consider your future career. Where I repeat, project finance is an area which you should not neglect. Okay, so what's next in terms of readings? You have MIGA investment guarantees. So what is it? MIGA is a kind of insurance which is provided, okay, MIGA is a subsidiary of the World Bank. MIGA stands for Multilateral Investment Guarantee. Okay, and it is the World Bank, as you know, is a major player as far as project finance is concerned in the emerging world and in developing countries. So Vietnam is indeed part of this group of countries and can benefit. Okay, so you see, they explain what are the eligible investments and under which conditions a project can benefit from this coverage, and which cover in particular, as you can see, political reach, which would include expropriation, breach of contracts, and so on. Credit enhancements is also an important case because it will improve the quality of credit, and it will be easier after that to get sponsors and lenders with no recourse debt. Okay, so that's the second paper. New tools now, new tools to overcome barriers to financing impact projects. Okay, these are the so-called impact projects. You know, I insisted on the importance of impact investing. Okay, and there are new tools which have been designed, guarantees in particular, which are kind of new. I mentioned the catalytic first loss capital. Here you have different guarantees, so I thought it was good for you to have a SEB and DIBs. I think it was an interesting point for you to have a documentation on these new possibilities due to the importance given to impact investing. Again, because it concerns most of the, I gave you that because most of the infrastructure project which you can think of in Vietnam would have a strong social and environmental impact. That's why being well aware of all these things is an important issue for Vietnamese decision maker. Project finance in Vietnam, you know, I didn't talk too much about this because you need to be Vietnamese to have a clear understanding of that. Okay, but it gives you all types of legal aspect of project finance in Vietnam with the regulatory framework and all that. I didn't comment on this, but I think you would have a better understanding than me because you have a better knowledge of the Vietnamese, let's say, specificities, if I may say so. And it concerns particularly the projects in the power industry. Okay, but that is a possibility for you to have a better understanding of what's going on in Vietnam as far as project finance is concerned. Well, that is important also. Standardizing 50% of project finance loan. It's published by Infrastructure Asia. Okay, I told you that standardization is a key element because it will allow banks to go further in project finance by having the possibility to refinance the loans they have given in the first place. Okay, and this is necessary for banks to continue to be involved, considering the strong constraints which are now imposed to banks to make sure they would maintain a good quality of their balance sheet. Okay, so this is also a trend which is important and which concerns particularly countries like yours. Okay, you know, it refers to the Asian market. So then you have some additional information about Vietnam capital market and project finance, to which extent the capital market in Vietnam is adapted to boost and to favor project finance. That's also an interesting paper. Okay. So again, this is the, let's say, Vietnamese flavor, which I thought was a good complement to my course. Okay. Here it's more a kind of methodological document where you have excuse me, I have some difficulties to upload it. It will come in a minute, at least I hope so. Here it's a guide where you will find all definitions of instruments and sorry for that. I don't understand why I can't open it. Oh, here it is. EPIC PPI guide, an introduction to PPPs, okay, with all type of information about this, okay. Principle of project finance, financing structure. So you see it corresponds to all the type of debt and equity, credit announcement. You see you would find all type of elements which we have discussed in the course, security structures and lenders protection, and so on. Okay, so that's a technical guide, kind of. And I gave you also, because I mentioned real options, I told you that it's difficult to, maybe difficult to value the real options. Nevertheless, they shouldn't be ignored when you value a project. And since it appears to me over the years that you are not quite familiar with this concept, it is nevertheless a very important concept in corporate finance and in project finance in particular. Okay, so you see a simple to implement real option method for the energy sector. So it applies to the energy sector, but then you will have a better understanding of what real options are all about. I really recommend you to read this, not only as part of my course, but also as a complement for your corporate finance knowledge and understanding. Okay, and you have an example of they come back on the DCF methods and the weak consideration of stochastic nature of cash flows. It's another expression to say that the DCF method is weak in the sense that flexibility is not integrated. So all that is well explained here, and that would be a good complement to your knowledge in finance. Okay, so this is just the few comments I wanted to make about the readings which you have as a complement of my course. So now, the last comment I will have concern the type of exam you will have, type of assessment. So the assessment is a group assessment, as you know. There is always a question concerning the number of people involved. The idea is that I know that you would love to be many, because that would be a lower charge for each of you. Nevertheless, don't forget that this assignment, don't take it as a kind of constraints, boring constraints, and so on. It's really part of your knowledge acquisition. It's the opportunity. Actually, I want to provide you with the opportunity to go in depth into the, let's say, the use of concepts and methods which are used in project finance, okay, through a case study. Okay, so the group, I think if it's bigger than 4, well, after that, it's bigger to know who has done what for us, and also it's inevitably, even if it's if there is a strong will of each of the person in the group to participate, if you are more than 5, I mean more than 4, it's difficult for each to be really involved in the project. Okay, so 4 is, I would say, a good max number. Okay, I know there might have an exception, because the problem is that if there are 4 people in each group, there could have 1 person left alone, so we don't want this. But it has to be a real well-justified exception if you're going to be 5. Okay, so now what type of question you may have, I will describe one project which I gave I think some years ago, so we'll have a good idea. I provide you a series of information, for a case. Here it was a solar PV project, and you are asked, you have a series of questions. First of all, build a forecast of cash flow available for debt service generated by this project. Okay, so you will work on the cash flow statement. Based on your estimates, provide a series of income statement and balance sheet for the period analyzed. That is, not only you have to look at the cash flow statement, but you will have to provide all the financial statements for all the period. In other words, let's assume that you have a 15-year period, because you want to fix a 15-year horizon. Then for each year, you will have to determine the cash flow available for that service, all the cash flow, all the detail of the cash flow statements, plus the income statement, plus the balance sheet. And indeed, you need to have a coherence between all these documents. Okay, For instance, a cash flow statement, you will have an accumulation of cash which should be coherent with the amount of cash you have in the balance sheet. Okay. Once you have all these elements, you will be asked to evaluate the project, and I will ask you to use the adjusted present value, because I did insist on this criteria to evaluate a project, which I considered as a kind of superior criteria in comparison with the NPV. Particularly with the NPV, you would need to calculate the WACC, which is not requested here because the WACC calculation would be very complex because the capital structure is changing continuously, and it's difficult to have a let's say, market value of the capital structure, so that calculating rigorously the WACC is nearly impossible. Okay, and you would have to determine also the annual debt cover ratio and the loan life cover ratio, considering the no recourse loan debt only. This was the question. An important remark, which will be there also for the project, but the question will be very similar to a certain extent to this. There may have an additional element to consider in the analysis, just to introduce this trend with green bonds and the like. Okay, but basically the remark will be the same here. Since it is necessary to make some assumptions to treat the above questions, you have to provide a justification for the choices you have made. In other words, what I'm saying, it's important. I will give you some details, okay, some technical details, considering the amount of debt and the conditions of the debt and so on. So you are not going to assume everything, okay? But there are some elements for which are not, some elements which will be important, and for which I will not tell you anything. Okay, so you will have to identify important elements and discuss within the group to know what are the most reasonable assumptions to be made for these particular important points. Okay, so don't expect to find everything in the data. Okay, there are some assumptions which you will have to do by yourself. Okay, so now what kind of data you will have? Investment. You have all types of technical data here, so that you can, first of all, know how much will be invested and when. Here, the total investment is spread over 2 years, 60% the first year, 40% the first year. You have data concerning the cost of the investment cost per kilowatt hour. You have the capacity, so you see, and the technology is a utility scale solar photovoltaic. Okay, so you have all these technological data which allow you to calculate how much you need to invest, when are the investment expenses are going to be made, and what will be the capacity and the production of the project. Okay, you have now some element of cost, okay, which will be useful for the income statement as well as for the cash flow statement. Okay, and you see you have a power purchase agreement here with different prices during 15 years. Okay, and then you have the financing, okay, with the percentage of sponsors' equity in this case. I just give you the beta zero debt of the project, but I may decide to give you some other elements, and you will have to calculate it yourself. It depends. So these are typical financial data which you recognize, and you have the financing. Okay, this is an example. Here you have a first tranche, which is total. It corresponds to 75% of the investment expenses as a complement to the equity. It's a bullet loan, okay, with the schedule, okay, and it's rated BBB, okay, with a spread of 200 basis points, so that you can have an idea about the cost of the debt, because you have the risk-free rate here, okay. And you have some conditions for the cost of debt here, which are indicated, sorry. And you have then a second tranche, which is a substitute for tranche one, okay? As I explained to you, usually you have a first tranche from the first phase of the project, which is risky, with a kind of debt which is usually very specific. Tranche two is more a no-recourse debt, traditional, okay? with a certain coupon, which is 3% here, which is a majority of 20 years, okay, and the loan repayment, which is a constant annuity, okay. Any year you have the scheduling. So this is the type of text you are going to have. Not exactly, it will not be this project. It will not, I have not yet fixed which project I will give you, but it will come probably in a few days, okay? And I will ask you now to provide me with all the data, for instance, and you have that on your slide, so you can look at the detail, for instance, of what you can provide me with in terms of calculation, okay? You can verify if you agree with me, but I have also added, I'm not going to comment this, but you can look at it. It gives you an idea about the type of table which I need, okay? Because there is also a dividend policy, so the dividends are also appearing here. And you see, what I need at the output, that has to be clear. I need all these tables, okay? But I need precise information on the assumption you have made to get all these numbers. Okay, sometimes I receive a document where there are just the tables which I have to look at and so on without much explanation. So ideally what I need is a kind of short report with all the tables and all the comments that goes together with each of the tables you present, okay? And as I said, there are some data which will be available in the text, but there are some implicit assumptions which you will have to make, okay? And you have to think about it. Okay, and I'm not mentioning which type of assumption you have to make, but there will have some important element to consider, okay? And you will have to discuss what are the best assumptions to be made about these elements, and you will have indeed to indicate this in your final report. So I am expecting a final report where you get all the data which I want, all the tables which I'm requesting, okay? With the valuation, the answers to the question I ask, and also all the necessary comments put in place in a concise way and a clear way. Okay? That's it. So we are a bit ahead of schedule, but I don't think it's that important. Is there any question now? I will open my camera so that you can see me. So is there any question before I let you go? Any question? When you say no Excel file needed, yes, we need. Well, if the Excel files are in your report, I mean, I don't need them, but it may be useful to send them together, because if I want to verify something, to know how you have calculated one point, okay, one parameter or whatever, it's easier for me after that to look and see what you have done. So because for your report anyway, you need an Excel file, then it's good to send me both, your report and the Excel document. Is that okay? No, I don't have any templates. You create by yourself. I just, if you want an example of a template, that's why I gave you the case study at the end of the course. You see the type of table I'm using, but you can create it. I recommend you create it by yourself. Okay. It's up to you. PowerPoint or Word, I don't mind. It has to be clear. That's it. I have no preference. Take the one that you feel is the best for you. If you conclude the Excel file, is it necessary to explain the calculation in the report? Well, I need the basic information. Okay? You don't need to explain to me how you have calculated the cash flow by taking this minus this plus this and so on. No, I know how a cash flow statement works and so on. But if there are few elements which you have calculated, or if there is something special, just indicate it. Don't explain everything, okay? But if there is something a bit tricky, just try to select what in your mind needs a brief explanation in addition to the Excel file. Okay? Any other question? Someone is writing, so I'm waiting for the... I'm waiting for the question. It's coming. No, the topic, the example you have is example of a solar power project. Okay, but it may be the last time for the last intake, they had an hotel project. You see, an hotel project in Indonesia. Okay, so it may be a tollway, it may be anything. Okay, I have not decided yet. I have different possibilities. I still have to write precisely the text. Okay, but it may be any type of project. The solar project, which you have in the files in the document here, is just an illustration of the type of exercise you will have to do. So any other question? In reading list, I do not see the article in Canvas. Okay. Okay, okay. Okay, I will I will make sure you have it very quickly. The real option paper. I understand why, because I asked Lynn to send you the document which I sent in January, and in January this paper was not in. So I will send it to you as soon. So I'm waiting. I see that another question is coming. The deadline. I was just about to talk about it. Well, I think that once you have the topic, okay, once you have the questions and the text, I think that 1 month is a reasonable period of time. Okay. Nevertheless, I'll see with Lynn whether it depends also on your workload now. So I don't want to, I'm not in a hurry personally, but I think it would be wrong to take too much time. You have the course now, so you will have the text in the current of next week. So my view is that 1 month would be reasonable. Okay. And you will receive some precision from Lynn. Together with the text, I will give you the deadline. But 1 month, usually is 1 month is what I propose. Please don't forget taking into the euro. I'm kidding. Taking into the euro. What do you mean with this? I'm kidding. Yes. Yes, I will take the euro rather than the dollar. If this is what you mean, yes, of course, because I'm indeed strongly supporting the European idea, and I just take the dollar sometime because I have to be realistic a bit. Okay, but I promise that the numbers will be in euro. Football, Prof, yes, we are going to win the cup. No doubt about it. No doubt about it. Yes, you can contact me directly if you need. I guess you have my email address, all of you. You can ask it to Lynn anyway. You can directly contact me if you have any questions. Some students choose to do that, no problem. And I usually answer quickly to your questions. But sometimes I answer the question, sorry, I have no answer for you. because sometimes you ask me to answer for assumptions which you have to do personally as a group. Okay, so don't be surprised if I answer to your question. You know, I don't know. Okay, but if you have a question, don't stay with it. Send it to me. Okay, anything else? The only thing I hope is that next year we'll be able to meet directly, maybe not with you because you will have finished your program, but let's hope that next year it will not be online. Wish you a good health and France will win. Yes, I'm happy to see that you are going to support us. Okay, thank you very much. You know, I know that attending a class online is not easy. You have to know that it's also not easy for us because we usually we like to talk to people. We see your face. We can see whether you understand or not. Here I just talk to my PowerPoint, and it's not quite fun for us. You know, we really prefer to be just talking to you directly. Okay, so good luck. Take care. I know the situation is not too good in Vietnam right now with the COVID-19, but I'm pretty sure that will improve very quickly now. Okay, see you, and very soon you're going to have my text. Okay, and I repeat, if you have any questions, either for the exam or for any other reasons, don't hesitate to contact me. See you, bye-bye. Au revoir. Ah, good. Some of you are trying to speak French. It's nice. Sin, I don't know how to write this. Sin. Sin Kaman. Is that correct? Ah, Xin Kam on. Ah, good. Xin Kaman. But, well, thank you. Xin Kaman. Bye-bye. I'm now going to have a nice French lunch, you know. But I would have loved to also have a good Vietnamese dinner in Hanoi or Ho Chi Minh. See you.
You are currently the only person in this conference.